Welcome. My name is Rebecca Taylor. I am from Tailored Investments, and I am so happy you're here today. We are very excited about what we're going to be covering. One of the most discussed topics that I get with real estate investing is the tax implications, the tax benefits. I have seen some incredible benefits personally from a tax standpoint, and I'm really excited to have a professional here with me today who can speak to this even more than I can. I always tell my investors, I'm not a CPA. But I can just tell you from my professional or my personal experience how good real estate has been to us. I was actually having a conversation the other day with a friend who's been in real estate for a while now. He did a deal with me recently and has his own businesses. And he mentioned to me a couple years ago, him and his wife sat down and they were looking at their taxes and they were like, oh my gosh, we are spending 3 to 4 months of our year working for the IRS. Like literally 3 to 4 months of the year we are spending giving our money to the government. How do we change that? And then they found real estate and everything changed for them from that standpoint. So I'm excited for us to dive into this topic. I think it's so important. So many people out there think that they just have to go through life paying a lot in taxes. And I'm not saying you shouldn't pay taxes. You need to pay the government what is owed. I'm not saying we should do something illegal, but there are just so many incredible benefits with real estate specifically we're going to dive into today from a tax front. So I have James Bohan here today. He is out in Idaho, and he is going to tell us a little bit about himself before we dive into some questions. James.
Rebecca, thanks for having me on here. Once again, I'm James Bohan. I've been a CPA for almost 15 years now, about 13 and a half, 14 years, depending on how you count it. And I grew up in a real estate family. I learned all about the blocking and tackling of building, property management, mortgage brokerage from my family members. And then when I graduated college, I just went and worked for a CPA firm and really slotted into the private equity real estate world and learned about how this asset class of real estate was being used as investments or what people call alternative investments, which has led to this development of a whole industry out there where people like Rebecca are pooling people's money together to go buy bigger buildings than they could build them, bigger buildings than they could buy themselves, or they might not have the expertise, so they want to get into business with someone like Rebecca who can help them achieve these real estate returns and get access to this asset class.
Yes, yes, you do amazing. I've enjoyed getting to see your work online. We connected and had some time together. We're going to actually be at two conferences together in the next couple of weeks, early March. So I'm looking forward to that. But for those that don't know, here at Tailored Investments, we find, analyze, and acquire income producing assets. And we just help people get into real estate very passively. I think a lot of times people think, hey, I have to be a landlord and deal with toilets and tenants and trash to own real estate, but that's not true. There are so many other avenues to get into real estate and still enjoy cash flow, appreciation, equity growth, diversification. It can be very hands off again with those tax benefits. So let's dive in today. I'm curious, just James, right off the bat, like what has real estate investing done for you from like a tax standpoint? How have you seen savings? And can you explain a little bit more about the intricacies of how it's worked? Maybe from the depreciation standpoint, we can dive into that here in a minute as well.
So one of the biggest benefits of real estate is you're able to take tax write-offs for an asset you buy, and that is called depreciation. And there is a few ways you can accelerate that depreciation. And using these mechanisms, you're able to say buy an asset for $1 million and maybe get like $200,000 to $300,000 in write-offs in that first year. You're often leveraging these properties as well, so you might be putting, anywhere from 250 to 400K into this $1 million deal, but you're getting those significant tax write-offs. And that's how I've been able to use this code, this IRS code, to help minimize my tax burden over my recent career as I've started to buy more real estate in Idaho, where I'm at. And that is one of the biggest benefits, I'd say. The other biggest benefit is you're able to hold your real estate forever and monetize the equity or value growth via cash out refinancings. And those are usually tax free when you get a loan against your property and take the money out. So instead of having to sell and pay capital gains tax, you're able to leverage the property just like some millionaires and billionaires do with their stock accounts that go up. You take a loan against it, it's tax free, and then now you have more money to go buy another real estate property and depreciate that and keep
Mhm.
the ball moving along.
It's so powerful what you can do. We actually did a cash out refinance on our personal home years and years ago because we paid it off early before I turned 30 and we were feeling really good about, being debt free. It was nice, but then we realized, we've got hundreds of thousands of dollars of lazy equity in our home that we can pull out debt free, tax free, and go out. We are creating debt. Let me make sure I'm clear on that. We are creating debt when we pull the equity out of the home, but it's tax free. And so then we're able to go and redeploy it and reinvest it. And it's just like it's unbelievable to me how we did that and that just created more cash flow for us in buying additional properties. And it was, I mean, such a smart way to use our money. Obviously it's nice to not have a mortgage, but at the same time the mortgage on our home is such cheap money, so why wouldn't we use it to grow our wealth? And people do that obviously with a lot of other types of real estate assets as well. But it's just cool to see the growth that you can have even with leverage, and taking out debt on property. I love it. I'm passionate about real estate, obviously. So thank you for explaining the bonus depreciation. Do you think so? There's been some changes, obviously, over the years. Bonus depreciation's been stepping down under the past administration. So far, we don't know if it's going to be back to 100%. Am I correct on that front? Have we gotten any updates if we're going to be back up at 100%? You can maybe expand on that a little bit too.
So I think what you're referring to, Rebecca, is that over the past, decade, bonus depreciation has been at different levels. In 2015, it was at 50%. And what she means by that is if you buy a property, like I told you, that $1 million property, you can do what's called a cost segregation study or a cost seg. But the segregation study segregates each of the asset classes within the real estate. So, with $1 million purchase, you'll maybe put 20% to land. And then with the $800,000 of building, you get one of these studies done and they'll say, okay, well, this part of your purchase is attributable to the actual building, and buildings are deducted at 27 and a half years. But then there could be special things like cabinets or landscaping or fences that all have different IRS prescribed asset lives. And anything that is in that 5 to 15 year IRS asset life is subject to something called bonus depreciation. And with bonus depreciation, you can write off 180, 60, 40% of that asset in the year you buy it. That's how we got to my example of taking a $300,000 write-off in the year of purchase.
Mhm.
Now, over the years, Congress has changed the rules on these things. And with the last tax bill we had, it brought bonus depreciation back up to 100% and then tiered it down 20% over the years. And so there's all this buzz in the industry right now that Rebecca is alluding to now that we have a new administration who brought in the last tax bill. And he was a real estate developer and he understands this very well,
Yeah.
that we're all, maybe people are already thinking it's a foregone conclusion we're getting 100% bonus depreciation back, but we're in the land of the crystal ball right now.
Yeah.
The government is very hard to predict. Sometimes they can move logically, sometimes they can move illogically.
Yeah.
I think more likely than not, we'll get some increase back into bonus depreciation. But
Mhm.
there's a lot of things that have to go into a tax bill, like budget reconciliation is how they passed the last one. So they have to, cut expenses
Yeah.
or raise money in other ways if they're going to reduce the amount they get by
Mm.
bringing back bonus depreciation. So there's a few hurdles they have to get over,
Yeah.
and we'll see how Congress interacts with this new administration. There could be a lot of animosity between who's in Congress, who's in the Senate.
Yeah.
Maybe they just want to bring everything to a standstill.
Mhm.
Maybe all this money that Doge is cutting is going to help with the budget reconciliation to bring back bonus. We're into crystal ball
Yeah.
land here, and we just have to wait and see.
Yeah.
But as it stands right now, it's a 40% bonus depreciation that you can take.
Mm.
Uh, when you buy something in 2025. And that's still a great benefit. You're still able to get a lot of those tax savings in the first year you buy. So I hope that clarifies a bit about the current situation with bonus.
Yeah. Do you think at all, if it does come back to 100%, will it be retroactive at all for like last year? I mean, we've got property last year we purchased and, I guess it was 60% bonus depreciation loss we were able to take, but I'm curious, who knows, obviously, but if they'll go back.
That was a big topic around this time last year, and a lot of people were like waiting to do their tax returns to see if bonus depreciation would come back. It was in front of the Senate, and actually my senator in Idaho, Mike Crapo, was on the Senate Finance Committee, and he was kind of blocking a vote of this to go down because there was some other things regarding the child tax credit that were in the same tax bill that he thought was too much welfare. And
Yeah.
so we ended up not getting this voted on last year, and there was a bit of a standstill because people thought it might have been retroactive to 2023.
Mm,
Uh, it could happen.
yeah.
I wouldn't say for anyone to wait to file their tax returns because you can make these adjustments in future year returns. So even if you bought something in 2025 or 2024, say, you could do the catch-up bonus depreciation in
Okay.
2025 through something called a 461A adjustment. So,
Okay.
don't wait to file your tax returns. You can still get your benefit in a future year if they make it retroactive.
Yeah.
It's hard to say if they will or won't. I would put my money on not, but anything is possible. And I
Mm.
never actually thought I'd see some of the things happening that are currently happening with our government right now.
Me neither. Me neither. Can you speak to depreciation recapture with this? What's the time frame and how does that look?
So there's two basically depreciation recaptures when you do this. So the bonus depreciation is subject to ordinary income recapture, and that will run through what's line two of your K1. So for those that don't know, a K1 is what you get instead of a W-2 from your job or a 1099 from interest or gig work. A K1 is issued to you by a partnership or an S corp or pass-through entity like a trust to give you your report or your share of the income from that entity. So it's broken out like line one, ordinary income, line two, rental income, line three, other rental income, line four, guaranteed payments, line five, interest income, and so on and so forth. So real estate investments usually will give you returns on line two.
Okay.
If you go further down, there's line C, which is for capital gains, and one of those line 9C is depreciation recapture. So there's actually two types of recapture. There's one that will run through line two,
Okay.
which is recapturing all the bonus at ordinary rates. And
Mhm.
then anything on a straight line depreciation will be recaptured at a 25% statutory rate. So if you're in a
Okay.
higher tax bracket, the recapture comes back at, say, 37% for the bonus, but the straight line stuff will come back in at 25%.
Okay. And how long of a time frame is that over?
That's over how long you hold the investment. So all the depreciation that accrues while you own a property will be recaptured via one of these two mechanisms, depending on what the asset class was that was priorly depreciated.
Okay. Okay. So I'm curious. I mean, I talk to investors a lot, and some of the real savvy ones that are doing these syndications, they almost use it as like a puzzle piece. So, or a puzzle. And then each deal they do every year or every couple of years it's to kind of move around. They buy one asset or get into one syndication. They've got a pretty large paper loss. They're still, and I want to make it also clear for people that are new to this. A lot of these deals are still distributing. It's not that they're actually at a loss, it's that they've got a paper loss from that bonus depreciation. And so, we're still seeing investors get money in their pocket from regular distributions. But, they'll buy one of these or get into one of these, they'll see a large loss and hold it for 5, 7, 10 years. And then every year, a couple years, they'll buy another one. And then as one's selling, there is going to be some large capital gains, depending on the profit from the exit. And so they're able to come in and buy something else that has a large loss to kind of, mitigate the gains and losses. So is that something you see, James, with your investors that are working with you?
Absolutely. And it works in a few mechanisms. So a lot of people have heard about a 1031 exchange where that's really when it's your property and you sell it and buy another one and you do a 1031 exchange and you pay no capital gains tax. When people are investing passively in the, LP alternative investments world, a lot of times they're building up these passive losses from all their investments. And when they have a realization or a capital gain or sale from one of these, it
Mhm.
will first go to offset all the passive losses that they built up.
Yeah.
And then oftentimes, like you mentioned, they'll take the proceeds from their gain and invest it into another syndication or another property and restart the depreciation clock.
Hmm.
And oftentimes this will, net out to zero tax due while they've made a bunch of money. but they invest in another deal. People call this the lazy 1031, where
Mhm.
they get a capital gain and invest it into another property. And this, if it's within the same tax year, this new depreciation will offset the capital gain that they just earned. Maybe there's some remainder of extra gain that they pay on. The math always isn't one for one, but it usually generally works out pretty well if you're just continually rolling these gains along and
Yeah.
selling something, buying another one, selling something, buying another one. And it's just a constant tax deferral game in this realm.
This realm. Yeah, until you die, right? I mean, like that's kind of with real estate. I mean, we plan to hold it, it's a long-term game. And then once you die, right, those gains end. I mean, in terms of if you were to pass it on to your children.
So what happens in that regard is that, let's say the phrase that I always say and heard is defer till you die. So you keep deferring these taxes, right? And upon your death, your estate is valued at fair market value.
Mhm.
There's some ways to discount this as well, family limited partnerships and dynasty trusts and moving things out of your estate early.
Mhm.
Advanced techniques out there. But generally, when you die, your heirs get a step up in basis. So let's say you bought something, like I said, for that $1 million, you depreciate them down to 700,000.
Mhm.
But when you die, it's worth 2 million.
Yeah.
So your estate will be taxed on that $2 million value.
Mhm.
And there's right now a $26 million exemption. So if your estate's below that, there's no estate tax.
Yeah.
But either whether it's taxed or not, your heirs will now get the new basis of $2 million at fair market value. So now they can start the depreciation clock at that stepped up basis. So that's kind of the idea, is defer till you die, pass it on to your heirs, and then they can restart the depreciation clock again as well. It's
Yeah.
it's it's quite a great tax system for real estate owners.
Yeah, I'm curious. I mean, like I have my ideas of why the government does this. What do you think? Like why is this a part of our code and why is it legal? I mean, it seems like why would they let us do this? But what do you think?
The tax system comes down to a couple things. One is incentives, and two is lobbyists. Like if you go back to ancient Europe, they used to tax homes based on how many windows they had facing the street. So everyone would build windows not facing the street. It's just people take what the government does from these tax rules and then acts around them to minimize their taxes. So
Yeah.
one, it's to incentivize, I think, home ownership and real estate development in the country. Real estate has so many tailwinds when you build it. You get your contractors, your GCs, then you have to buy all the appliances, and then with a new home, people have to go and furnish it. So it's a big boon and spur to the economy to incentivize home building and real estate building, just because it hits so many things down the value train.
Yeah.
The other side of things is lobbyists. The real estate lobby is one of the most powerful lobbies
Yeah.
in the United States. So they are in the ears of congressmen and senators, helping to make sure the rules stay favorable to real estate. And oftentimes, a lot of these congressmen and senators have a lot of real estate themselves, just like our current president does as well. So I think it's a
Yeah.
combination of incentives and lobbyists create the tax system that we have.
Absolutely. I think you hit the nail on the head. That was really good. And Andrew Carnegie, a very well-known entrepreneur and millionaire long ago, said 90% of the world's millionaires became so through real estate. And I think that's speaks to just the power of what is here. And again, so often people don't take advantage of these benefits because they don't know, or they think that they have to go this difficult route of being a landlord and doing it more hands-on. So I'm obviously excited about what we're doing here and be able to share that with our investors. So another question for you. You talked a little bit about, or we talked about this offline. I have a lot of friends that are realtors. I'm a realtor myself, and many of them, as I'm having conversations with them, most of them don't invest in real estate. I think they just don't want to deal with the hassles, and they don't maybe see these benefits that we're talking about. So, can you speak a little bit to those qualified real estate professionals that fall into that bucket, what that is, and then also speak to, if they were to get into a syndication or owning their own investment property and taking that bonus depreciation, seeing these big losses on, these K1s, would it help offset their large gains that they're making with their transactions as a realtor?
Yes, absolutely. And there's a few hurdles you have to jump through here. So, what you're alluding to is that rental real estate is considered a per se passive activity by the IRS. And so we have to, break things down a little bit here that there's a few different kind of buckets of income. One, there's like your ordinary income. That's like your W-2, your 1099, you're running a business, you're getting stuff called ordinary income. Then there's this idea of passive income, but passive income, we'll get back to this, is not portfolio income like you might think it is. So if you think about interest, dividends, bonds, as a just person operating business, that's passive income. I bought a stock, I made a loan. It's really passive, but
Mhm.
from the IRS's perspective, that's not called passive income. That's called portfolio income. So
Okay.
what we're really talking about here is active versus passive income. And this usually revolves around investments in businesses or business activities. So like I said, ordinary income can be active income or passive income. So if you invest passively in a real estate project, that's usually deemed passive income.
Mhm.
Now, to be a good tax professional and a savvy tax investor, you need to know the exception to the rule and the exception to the exception to the rule. So you sometimes you want to be a passive investor because all your other income is passive, and then so the passive income gets offset by the passive losses. But
Mhm.
oftentimes, like you said, there might be a real estate broker who's making a lot of money in commissions, which is active ordinary income, but
Mhm.
they want to make investments to get losses, and they might not want to, like you said, be a landlord because real estate's a full contact sport. You don't want to go fix the toilet at midnight when the pipes freeze.
Mhm.
So there's this idea in the IRS code called real estate professional status.
Mhm.
And so where this is people who actually work primarily in real estate, over 750 hours a year, and no more hours in any other businesses combined than what they work in real estate. So if you work 1,000 hours, let's say a real estate broker, and 500 hours as a plumber, call it, you qualify as a real estate professional because your real estate professional hours are more than your plumber hours. So that one just gives you status as a real estate professional.
Mhm.
Then you can make what's called a grouping election and treat your like real estate brokerage business activity
Mhm.
and group it with all of your passive investments. Otherwise, that would be passive investments. And then you create this one business activity that's grouped for all your real estate trades or businesses. And
Mhm.
then by looking at that, you can start looking at the material participation thresholds,
Yeah.
which are what designate something active versus passive. So first, it's to meet the threshold of 750 hours. And
Mhm.
then two, it's grouping enough activities together to
Yeah.
meet material participation thresholds, which there are seven of. The most known one is the safe harbor of working over 500 hours in an activity. So if you're overworking 750 hours in your real estate trade or business, you usually generally qualify to meet that
Yeah.
material participation threshold.
Mhm.
Now, there's a few more exceptions to these rules to unlock the real estate otherwise passive losses that can be written off against your W-2 or active income.
Yeah.
Just quickly there, if you're, let's say, a doctor's practice and you own your own building, you can group your doctor's practice and your rental real estate of the building
Mhm.
together and then write off the depreciation against your doctor's practice. I just got a
Mhm.
new client. I'm saving this group of doctors over $300,000 in taxes by doing this. They're quite happy with me.
Yes. I
And
love
then
that. That's awesome.
Yeah, and then the other way is using the short-term rental loophole
Mhm.
because the IRS won't deem that activity if you meet a certain threshold, such as the days less than 7 days per average stay, then the IRS more or less views that as like running a hotel in
Yeah.
some ways, and so they don't count that as passive, and you're able to use that short-term rental loophole, as they call it, to offset active or W-2 income. There's a few other hoops you have to jump through to qualify there, but I hope that answers your question and illustrates that.
Yeah, that's amazing. Let's use just one quick example. Let's say we've got a realtor that's making $200,000 a year, doing transactions. They don't have any of their own rental properties, but they're paying, I mean, let's just say for easy numbers, what would they probably pay in taxes on a 200,000 per year salary? I mean, it may be like 30%,
Yeah, it
20.
depends on what state they're in,
Yeah, it depends
like
on the state.
we
Like
want to
there's a
look
lot of
at
factors.
federal
Well, there's a
taxes,
lot of factors. Yeah. So
30
let's
to 30 to 50%, let's call it.
yeah. So they're paying 50,000 to, I'm trying to do my math here in my head, 50 to 80 or 100,000 in taxes. It's a lot that they're paying out in taxes every year. So then they decide, hey, I want to go put $100,000 into a syndication, and that syndication is able to take a 40%, bonus depreciation paper loss in that first year. So it's going to show a 40% or $40,000 loss. Is that right on the K1? And would that kind of help offset that large gain that they're having to pay on their taxes as a realtor, again, paying, am I on the right track here with what the numbers could look like for them? I know it's
Yeah. So, if they can meet the real estate professional status and, they actually own their business or own at least 5% of the business that's paying them that $200,000,
Mhm.
they can take this investment and write off $40,000. So now their taxable income drops to 160K. And then
Mm,
if they're at that marginal 30%, like you said,
yeah,
that 30% times the 40K translates to $12,000 in immediate tax savings for the year of that investment.
that's awesome. I love that. Yeah. This is why you're here, is to break all these things down, because I do not, I mean, we have an amazing CPA that does all this for us, and I'm always like, how? This is incredible that you're able to figure out these losses, despite the gains that we're having. And so, yeah, thank you for explaining that. And I hope that I always am telling my realtor friends, you really need to think about investing in real estate. Like, there's so much that could help you save money on your taxes because you're paying a lot, and being self-employed, there's a lot of different factors involved in that. So thank you for sharing that. Let's see. I think that's a majority of the questions that I wanted to ask. Is there anything else you want to add or that I forgot to hit on? I was trying to think. I had a list here and I've gone through all of them, but I feel like there's something else that I wanted to share. So anything else you had in mind?
I think one thing you mentioned you want me to talk about is opportunity zones.
Yes,
So
yes, yes.
they are something that came about of the last legislation, and without any renewal of this or a new tax code change, it will sunset. The opportunities will go away at the end of 2026.
Mm,
So it was a cool bipartisan
mm,
aspect of the last tax bill where they went around the country. They had each state designate these certain low income areas
mm,
as what were deemed qualified opportunity zones.
mm,
So they offered some great tax advantages to invest in them. So first, in order to take advantage of the tax advantages, you have to fund your investment with a capital gain. So unlike a 1031 exchange where you just defer the gain indefinitely to another sale,
yeah.
you can invest your capital gains in these opportunity zones and defer the taxes due on the capital gains until 2026. So that
Mm,
was the first benefit.
yeah.
And then the second benefit was if the project holds these opportunity zone investments for 10 years,
Mhm.
any gain on this sale of the opportunity zone is tax free, which
Wow.
is just really cool. It's the only time you see this in the code, really. It's just an
Mm.
elimination of tax,
Oh
not
my,
a deferral, not a step-up basis,
yeah.
not, pay taxes later, a straight elimination of tax. So it's a really cool
Mhm.
way to invest in something. And, it had a lot of bipartisan support because these are low income areas that could, need the capital infusion.
Mhm.
And the program's been pretty successful, I'd say, over the past 5, 6 years since it's been implemented. And
Yeah.
so, there's a lot of buzz about, oh, is bonus depreciation coming back? Is our opportunity zones being extended? And, I'm hopeful for it, but,
Yeah.
you still have another year and a half or so to get into one of these investments, and they're usually pretty good.
Yeah, that's awesome. I have a friend doing an opportunity zone development in Tennessee. So it's been really cool to watch him. He's a part of a mastermind I'm in. And yeah, so much opportunity there. So thank you for alluding to that. One other question I just thought of, we're talking a lot about real estate. Obviously, we both are passionate about real estate. But in terms of other assets with great depreciation and tax benefits, are there any others that you recommend or you've invested in personally that you would share with us?
The other one that I see out there that one I haven't personally invested in because I don't live in Texas is oil and gas. So when you invest into something that is a working interest in oil and gas, you throw all these passive loss rules out the window and you can start taking these oil and gas losses against your W-2 income without having to be a real estate professional, there's no such thing as like an oil and gas professional.
Mhm.
These working interests give you a lot of that depreciation and deduction up front. Because once again, like I said, it's a matter of incentivizing activity. Energy is a factor in everything that we do. And
Mhm.
then lobbyists. The oil lobby is just as strong, if not stronger than the real estate lobby. So
Mhm.
oil and gas has some of the best
Mhm.
tax savings without having to jump through some of these hoops.
Yeah.
But like I'm not sure how easy it is to find a good operator in this space. It's like, hey, I got, a bunch of land in Midland, Texas, and you want to come invest in it? It's like I got a bridge in New York to sell you as well, too. Like I've been in real estate my whole life. I can't get my head around it. Like I said, I don't live in Texas,
Yeah.
but they do have great tax losses you can get from oil and gas, but just make sure those tax losses don't become real losses by making a bad investment with the wrong person.
Yes. I cannot agree with you more on that. I think you got to find the right operator that's been in business a long time, and technology has really impacted it. We've been looking at some oil and gas. We haven't done it yet either, but I'm intrigued by it. It is almost a flip with real estate. Real estate, we still have an asset at the end of the day, and we're making cash flow. It's probably a lower amount from a cash flow standpoint. Is the every asset's different, but it's a long-term play. You still have the asset at the end of the day. With oil and gas, you're probably getting really high cash flow at the beginning and obviously really big tax benefits, spitting out money as it's producing, and then it slowly dries up. So eventually that investment's gone. I mean, like you don't have something that you can sell. It's so different from real estate. So that's been hard for me to wrap my mind around too, is, making sure that that's a good place to put our money. So we may get into that in the future. It's definitely intriguing. One other thing I just thought of, I just want to make really clear, as we're talking about losses, on your paper losses, depreciation, bonus depreciation. One question I get all the time is like, are these losses going to offset my active income? And James has alluded to this already. No, I mean, like it's different in the sense that you are going to pay taxes on your active ordinary income as a W-2 employee, but right, James, I think that's what you're saying. But, as you invest more in real estate, the gains you're getting from real estate can be offset by these depreciation, by the paper losses. And as you build more and more real estate and it continues to, appreciate and cash flow even more, and then eventually you turn around and sell it for a profit, those gains are offset by, losses on future investments. Am I correct in that? I just want to make it really clear because I get that question a lot of like, hey, I'm going to see these paper losses. It's going to be great for my taxes if I'm a W-2. And I'm like, wait a second, check with your CPA on this.
Yeah, that's exactly right. Those gains can be offset by not just, the future deal you do, but also the past deals you do that might have built up these passive losses. And
Mhm.
then remember that the real estate professional status rules, it's just one spouse has to qualify. So, I'm a CPA. My wife just got her real estate license and she's managing our property. So now she's the real estate professional in the family from the IRS's perspective. And there's, certain ways to work within the rules to not have all your losses be trap passive. For real estate brokers, like you said,
Yeah.
investing in real estate is a great way for them to legally minimize their tax burden.
Yes, absolutely. I'm a real estate professional as well, so it's been extremely helpful, especially when my husband was in a W-2 because we were able to work together on that. So it was very just an incredible way to file jointly and take advantage of some big savings. So yeah, thank you for that. And we need to track our hours, right? Like it's important to be tracking the amount of hours that we're doing on a regular basis, I assume.
Yes, that's the ultimate audit proof way. So if you get audited, the IRS is going to look at this. They're going to say,
Hmm.
it's really hard for someone with a W-2 job to say like, oh, I'm working 2,000 hours in this job, but I'm working 2,001 hours in real estate. Like, well, show me the receipts, show me the paper. And so there's better living through technology right now. I recommend an app called Toggle, Toggl,
Yeah.
or Blockify, or just a good old fashioned Excel or iPhone notes.
Yeah.
But make the log in real time. It's the way to really be the most audit proof, defensible mechanism if you do get audited to really justify your real estate professional status and take advantage of these massive paper losses.
Yeah, that's so good. Thank you, James. Thank you so much for your time today and all of your wisdom that you shared. I know this is years and years and years and years of professional work, and I know that you're not cheap to work with. And so I'm so thankful that you were willing to spend the time with me today. You're very, very wise in this space. If you guys are looking for a CPA, James does an amazing job. He also has tax strategy. Is that really your focus, or is it kind of a combination of CPA and tax strategy that you're doing?
Yeah, the tax strategy is the most important and most rewarding to me. Like I said, helping those doctors out. They've had other CPAs over the years. I come and say, well, you guys own a building. Why aren't you bonus depreciating it? Or taking Section 179 on your tenant improvements. I'm not a box checker. I didn't get into this profession to fill out, forms. I love thinking strategically. I love advanced planning, over years, decades. I love helping with some of those advanced estate planning tools using either dynasty trust or family limited partnerships. That's really gets me energized and excited. I have a whole team that helps with the tax return preparation. And if people want to get a hold of me, I'm very active on LinkedIn. I'm James Bohan, CPA MRED on there. And then my company is Stonehan. That's stone like a rock, Han like Han Solo. I named the company after my grandpa, David Stone,
Mhm.
and combined it with my last name, Bohan. So we got Stonehan. And that's how the business I operate under to help people with their tax and CPA needs.
Yes, and we'll include your information as well on our page and emails that are going out. So thank you again for your time, guys. If you're interested in investing in real estate, you know I'm here and I'd love to help you think about how much time you're spending working for the IRS every year. And let's figure out a way to get that down. Maybe you can save some money and work with James in the process too. So thank you guys again. I appreciate you being here. Have a great day.